Are you a beginner investor who's been caught up in all the highs of the stock market? Are you just dipping your toes in the world of investing? Or have you been investing for a while and are unsure of how to allocate your equity? How much percent you should put into stocks and how much percent you should put into bonds? If this ticked any boxes, then this video is for you. Hi, my name is EvolveHumans and welcome to my channel. If you're new, this channel is where I talk about money, how to make it, and how to keep it forever. Asset allocation in your investment portfolio is always a tricky business. There is never one answer to rule them all. One portfolio to rule them all. One portfolio to find them. And in the darkness, find them. And despite what some investors say, it should be a very personalized experience if you're doing it right. Most of us don't even know where to begin with asset allocation because there's so much information around. Perhaps too much information around. And we get stuck in a thing called analysis paralysis where we read and plan, but never actually put our money into stocks and bonds. So we lose the greatest asset we have, which is time. Time we could spend earning interest and money for free. For those of you who don't know what asset allocation is, here's a quick summary. Skip it, it's about 10 seconds long if you know what it is. Basically, asset allocation in a portfolio is choosing how much risk you want to expose yourself to compared to safe bets. Risk means higher rewards. Safe means less gain, less reward, but less chance of losing your money. Higher risks are stocks, lower risks are bonds. And balancing your assets and allocating your assets is balancing how many stocks you have and how many bonds you have and changing the percentages over time. There are a lot of other factors involved, but for the purposes of this video, let's assume this is true, and this is the only thing that it affects. So how should you distribute your assets? What sort of allocation should you have? How much percent of stocks and how much percent of bonds should you have in a secure and strong portfolio? This is where most people get stuck because they can never take the first step. Here are a few ways to make this really easy to do. Let me use the so-called rules of thumb. These rules of thumb were taken from an article from Monevator. Monevator is a very good site for beginner investors and advanced investors because it explains it all in layman's terms as detailed as you like. So here, check them out. I'll leave a link down in this description for Monevator. I am in no way endorsed by Monevator. If they want to endorse me, now's your chance. Anyway, so the 100 minus age rule of thumb. According to Monevator, this rule is so old, it deserves to be in a retiring home. Seriously, this is an age-old tactic for asset allocation. What you do, you take 100 minus your age, so let's take my age of 27, that will be 73. So that's the percentage of your portfolio that should be in equity. Variable income, 73%. The rest should be in bonds and safer assets. And over time, your concentration in equity keeps going down because technically you're saving for retirement. So when next year, when I'm 28, I'll have 72% in equity and 28% in bonds. And by the time I'm 60, the average retiring age, it will be a 40-60 split because you want to have safer assets rather than more risky assets to maintain your money and live on your retirement. That's a good way to start. A popular spin-off for this rule is subtracting your age from 110 or 120 and you have a higher risk, so you have more equity, but your money grows much faster. Another rule of thumb is the Tim Hale target date rule of thumb. What if you're not saving for retirement? What if you need to save some money for a very definite date? For example, your house, or a wedding, or a party, or a college fund, and you need it for a certain date. How do you save the money this way? This is a rule that lets us be relatively aggressive early to earn more money quickly and slow down the aggressiveness, distributing less stocks and more bonds as we get to the due date. So there isn't as much fluctuation in the value of the investment. Makes it safer nearing the end, already having made use of aggressive investing in the beginning. Tim Hale's suggestion, an English investor, in his UK-focused investment book Smarter Investing, says to invest 4% in equity for every single year you are investing. For example, if you're going to invest for your son's college fund in 18 years, you'll invest 4 times 18. That's this much. So that's 72% equity and 28% bonds, and each year 4% of equity is taken out of the portfolio and converted into bonds. So this means nearing the end of the 18-year period, you'll almost have 100% bonds and complete security that your son will have the amount of money he needs to go to college. This works over any time period. Of course, if you're going to save over 20-25 years, it's going to be over 100% equity. So you should just use the 100 minus age rule of thumb, or just invest 100% in equity if you can handle the risk. This is another way. Then you're basically investing for retirement. And there are a few others. Here's another one. This is one by Harry Markowitz. The 50-50 rule. This is one of the simplest rules you can ever do. And he is one of the fathers of modern portfolio theory, which is a whole other topic, but he got a Nobel Prize for this discovery. And when asked about his personal investment strategy, Markowitz said, "I should have computed the historical covariance and drawn an efficient frontier. Instead, I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. My intention was to minimize my regret, so I split my retirement pot 50-50 between equity and bonds." First of all, he doesn't talk like that because he doesn't sound like an idiot. Second, what this means is every time the stock market went way up and he wasn't in the stock market making use of it, so he was more in bonds and less in stocks, he got really angry and sad. Every time the stock market went way down and he had too many stocks, he would get angry and sad. So, instead of feeling regret and grief for retirement, he just split it 50-50. You can copy that. It's easy, a no-brainer. Just keep adjusting as the years go by. It's a good option. And the man knows what he's talking about. The Larry Swedroe come out punching rule of thumb. This method is gung-ho for 20 years. It is all 100% in stocks. Here's a table. Look at this. In an investment horizon of 20 plus years, he says to invest 100% in stocks. So, if you're 20 and you want to retire at 40, 100% of all of your investment should be in stocks, because that gives you the maximum amount of gain with the lowest amount of risk. The longer you invest in stocks, the lower your risk gets. This is a study that I'll explain at another time. But basically, a few statistics. In stocks, in a 5-year horizon, there's a 1 in 4 chance you will lose your money. In 10 years, there's a 1 in 6 chance you'll lose your money. And over time, this tends to grow less because the fluctuations over a long period are much less than over a short period. And over a long time, if you keep holding on to your good stocks, you'll be less likely to sell in the bad time. You'll accumulate the huge gains by the stock market, and you'll have time on your side, and time levels most things out. And the historical trend for stocks has always been up. And you can keep it going in the future if you hit the like button and subscribe to my channel if you like the content so far. That's a lie. But please like and subscribe if you like my content. Get your face out of it. Anyway, back to Larry Swedroe. According to the table, for every year that your investment horizon goes down, you start losing equity percentage, which are replaced by safer assets, like fixed income. So for 15 to 29, you'll lose 10% equity, and then it goes quickly down until you're 4 years away from retirement. You should only really have 10% stocks left over and 90% bonds, because then you're basically guaranteed to have the income that you planned for as you retire. Because you don't want to have 90% stocks, have a bear market, crash all your net worth just as you're about to retire, because then you'll sell in the dip of the market, the worst time to sell ever. Never put yourself in this position. This takes advantage of the long-term stock growth and still saves you with fixed income safety at the end. Mr. Larry Swedroe also has the no rule of thumb. This rule considers how much risk you can actually handle. This is a simple table. Look at this here. So if you thought, I'm going to retire in 20 plus years, I can take the risk, and you've never been in a bear market, can you really take it? Can you really see 50% of all your net worth go down the drain for a few months, years, even a decade? Because that's how long it took from 2000 to 2008 to regain all of it, just to crash again. Even a decade, because some decades in the past have taken exactly that long to go from the big dip bear market back to the start? Can you take a hit for 50% of your net worth invested in stocks? If no, lower your risk, so lower your stock allocation. It's no crime. If you don't think you can take it, be honest and allocate less money in stocks until you think you've learned enough to take it. Because if you think you can take it and then panic sell, you'll sell cheap and lose money. No one wants that. This is a channel for making money. Otherwise it would be EvolveHumans. That was terrible. Now, these are not end-all methods, but they are great first steps. These rules of thumb can help push you over the edge and finally take that first step to the world of investing, the amazing world of investing. And then you can finally have time as your ally instead of your enemy and learn the magic of compound interest. The earlier you start, the more money you'll have at the end. So this will help you take that first vital step. Over time, you can adjust the percentages of stocks and bonds as you learn more about asset allocation. So you educate yourself constantly and then fine-tune to your individual preferences. As I said at the beginning of the video, every portfolio should be unique. So my portfolio shouldn't be copied by you, but we can get ideas here and there from everyone. These rule of thumbs are a great idea to have. If you want to find out more about beginner's tips to start investing, check out this video right here and I'll see you there. See ya!